Good to be back here at Delphi. I will now return us to the English language portion of our program. There may be a time when I can do this in Greek and do a Delphi panel in Greek. Today is not that day, however, so I'll stick to English. My name is Peter Spiegel. I'm the U.S. Managing Editor of the Financial Times, and I'm joined here by CEOs of two of the four systemically important banks in Greece. As always at Delphi, a very well-timed panel. I leave New York for 3 days, and yet another bank seems to have fallen into insolvency. Incredibly well-timed time to talk about the banking system in general, and particularly what we call in the U.S. now March Madness, which was a period where we saw two big banks fail, including the second largest failure in American history, and obviously the events in Switzerland, which is interesting. And this is a topic that was discussed at the central banker panel, because we have here American banks and non-Eurozone European banks. And for someone who spent quite a bit of time in Brussels covering the Eurozone banking crisis, it was, I guess, a relief for the both of you and for most Eurozone banks that it was not a Eurozone banking scandal. Now, Vice President Guindos was pretty confident that that was because of things that had been done in the ensuing years. Pavlos, let me ask you the same question, but ask it in a slightly different way, because Fokion made the point.
He exhausted most of the answers.
The answer is a good question. The answer, all the good answers, that's right. But he raised an issue that as someone who spent a lot of time writing and watching the Greek crisis and the Eurozone crisis more rapidly, was slightly surprised that the lessons of Greece were not passed on, which is this issue of what you hold in your investment portfolio, right? Everyone says you should invest in treasuries, it's such a good idea, it's safe, it's liquid. However, that is in many ways what brought Eurozone banks down. There was this phrase, the doom loop, right? You held sovereign debt, which is supposed to be safe, and then suddenly Greek sovereign debt went into the toilet. And so did Portuguese, and so did Italian. And so all the banks that were otherwise relatively safe had capital on their books that was suddenly worth nothing. And I'm just curious, two questions on this one. One, did the world fail to learn the lessons of the Greek crisis and the doom loop? But also, does someone need to recalibrate the safety of sovereign debt, particularly at a time when you see rates going up as fast as they are?
As Fokion mentioned, there's a question when you hold sovereign bonds of interest rate risk and how you handle it. And clearly, the case of the US right now, it was poor ALM, asset liability management, of the interest rate risk. The European crisis was a question of credit risk. There were questions about the ability of the sovereign to repay its debt. So it was a credit issue, and the whole question of whether the Eurozone was going to fail. And therefore, there was a revaluation of the bonds due to credit, which hopefully will not happen again in Europe. But it was two different issues. Second point is the question of banks holding too much sovereign debt. Here, again, we have a regulator who looks at us and pokes us and tests us every year in our annual SHEP analysis. We have a risk appetite framework which we need to have approved and checked by the regulator that we are within fair and logical limits. There was a debate, which I think now has ended, about whether sovereign bonds should have a zero risk weight in Basel. And I think rather than applying a sort of horizontal rule that you need to risk weight sovereign bonds, which some countries still are pushing for, the more AAA countries clearly, it has gone to more that the regulator should look at a bank-by-bank basis based on their other assets and liabilities.
Let me ask you again, because you talked a bit about the regulatory authorities and the stress tests. One of the things that seemed to be the criticism in the US of the Fed in particular was monetary policy and macroprudential policy were two things being done by the same institution, but not really looking at each other. That the monetary authorities were raising rates so quickly, and the macroprudential authorities were not focusing enough on what that impact would be on the investment portfolios. How concerned, how comfortable are you that that is not the case in Europe, that the ECB, which also has monetary and macroprudential roles, I mean, obviously it's spread over other agencies as well, that there is more integration there, or do you think there needs to be more integration?
I think there's integration, but let's not confuse the two. One is a through-the-cycle policy, a macroprudential. You don't sort of put on more macroprudential when you're going down. That's a pro-cyclical policy, and you don't want that. Macroprudential is putting a little bit of sand in the wheels of during the cycle, okay? LTV ratios, loan-to-value ratios, PIT ratios, leverage ratios for highly leveraged firms that have high loans to EBITDA ratios, collateral valuations of ships. All these are ways of slowing things down on the upswing, okay? And I think in Europe it's they're quite strict already.
Yep.
And getting stricter.
You may have just answered this question, but let me ask it slightly in a different way. In that Pavlos was mentioning that sand in the wheels, right? That the effort right now by the central banks is to slow things down slightly. We heard the last two panels. Clearly, the election here in Greece is going to be, in a large part, campaigned on cost of living increases and whatnot. We have seen inflation start coming down, both in Europe and the U.S. But one of the things that came out of the U.S. was concerns about a credit crunch. That even if the banking system itself is relatively stable, and these are all one-offs, that there may be a drawback in lending, particularly corporate finance, into the real economy. And I'm wondering to what extent you are anticipating that here. It sounds like what you just said, that the asset quality seems to be pretty good, therefore not. But tell me, both of you, with both of your banks, what you're seeing, whether your lenders and your banks are being pulled back a little bit. And also, let me just ask a follow-up to that, which is that necessarily a bad thing? Because, as we said, if we're worried about inflation, if the banks are pulling back credit slightly, that kind of feeds into that slowing down the economies.
I think when we talk about Greece, we got to remember where Greece is in the cycle.
Yeah.
Okay.
Yeah.
We have come out of a 10-year cycle of drop in GDP, households and firms under-leveraged. It's 50-60% of GDP leverage compared to double that in the US and in most European countries. There is momentum from all the restructuring that has been done over the past year. So we're entering this crisis with strong momentum. I mean, banks do as well as the economy, especially in a bank-centered economy like Greece. So we had high growth in 2022. We're going to have much higher growth in 2023 than most European countries. We're 2.3, 2.4, 2.5, even higher as the numbers are going. So in that sort of strong economy with real estate prices going up rather than down, employment being created, high firm profitability, you're not going to see a significant drop in loan demand. Slowing, perhaps. Mostly, I'd say, in the household sector. But in the corporate sector, I think we're going to see strong, and we have the RRF funds. We have foreign direct investment coming in. All this is not going to lead to a crunch.
Okay. Said which is the corporate sector and lending into corporate finance. Because I was reading the S&P upgrade recently, and it was interesting to me the focus they put on the banking sector, the health of the banking sector, and the really significant increase in investment in this country. Tell me a little bit about that, how that has played through the banking system, because I guess one of the sure signs of a healthy economy and a healthy banking system is the origination of loans to companies that are investing in the real economy. There's been some argument that a lot of the growth of the last 2 years has been consumption-based. So, sugar rush because of stimulus in the pandemic, and stimulus because of the energy sector. What do you see in terms of benefit on your loan book on companies coming to you and saying, I want to invest in the real economy? And how much it is domestic investment, and how much are you seeing even foreign companies coming in and wanting to originate loans and get some financing for work here?
Again, we're in a very positive part of the cycle because we're seeing both foreign interest as well as domestic interest. Greece, after the crisis, had fixed investment as a percentage of GDP in single digits. And on a net replacement basis, almost zero. We're bouncing back. I think we're now 13, 14% of GDP. And I think that'll continue to go towards, converge towards European levels of 18, 19% of GDP. That is a lot of bank loans.
Yes.
Okay? Because it's basically the banks that are going to provide that financing. So the interest in Greece, it's competitiveness, and I would say that we didn't have consumption-led growth. We've had investment-led growth, and we've had export-led growth, which is very positive. Consumption's been relatively stable as a percentage of GDP. So all the signs are positive for the banking sector that there'll be strong demand from corporates for specific investments, energy, tourism, and others. Okay, so.
Last topic, because we're running out of time. The other thing the S&P report highlighted, which I must say I have missed because I've been back in the US for 4 years now, is the incredible work through with the NPLs. Tell me just very briefly about how that was achieved, but also how that frees up capital to loan into the real economy. What does that mean for the real economy in terms of the financial system able to sort of do its job?
I mean, initially, we had need for capital to build up provisions and to clean up the NPEs. We had almost 50% of our loan book was NPEs.
Not performing.
Now, on a net basis, we're at a few billion, okay, versus a capital base of 22 billion, 25 billion, something like that. So,
amazing, yeah.
So we've managed to not have competition for capital from the NPEs. That's gone. So that has been there, you know. So now we have the capital to lend, and that's so the NPE issues has disappeared, I would say, from the horizon. We still have a little bit more to do, but it's no longer an issue. Okay.
I was going to ask you to follow up, but I'm getting the hook from the organizers here. First of all, it is a great pleasure to come to Greece for the good news in the banking story, having left the U.S. where the bad news of the banking story is. Please join me in congratulating these two men and thanking them for their comments.